The Property Bulletin by London Property, the home of superprime.
London is brimming with capital, waiting to be invested in housing, and Melanie Leech of the British Property Federation, BPF, has an idea to unlock it. In her vision, London needs another housing boom, much like the transformative ones of the past. The late 19th century gave us the Victorian terraces in zones 2 and 3. The 1930s saw the Metroland developments build much of the outer suburbs, and the post-war council house boom replaced older homes and filled in bomb sites across the city. Now, today's housing crisis demands a burst of building on a similar scale. Since the 1980s, London's population has grown by almost half, yet the number of homes has only risen by a third. This supply gap has contributed to historically high rents and made home ownership in London a minority tenure, 48% and falling compared to 65% nationally. To bridge this gap, the BPF's manifesto, Building Our Future, calls for critical changes to the planning system to ensure it delivers new homes and the essential infrastructure that supports them, especially in London where the need is greatest. To unlock development at pace, more planners are needed. Major political parties are committing to providing more resources, and BPF members have consistently expressed their willingness to pay higher planning fees for a system that delivers faster and more effectively. The goal is to provide homes for people of all ages, families of all sizes, and cater to a wide range of budgets. The good news is that there is a vast amount of capital available for investment in new London homes. If we're smart about accessing it, we can unlock more build-to-rent BTR properties, housing for older people, student housing, and affordable and social housing, addressing Londoners' diverse needs. BTR properties have emerged as a vital component of London's housing supply, with almost 50,000 new homes completed. Unlike the traditional buy-to-let market, buy-to-rent developments are built at scale, specifically designed for renting and typically managed as a block by professional companies. Rents in BTR are broadly similar to the wider private rented sector, but with long-term leases and predictable rental increases. Tenants can enjoy greater security and easier financial planning. BTR offers numerous other advantages, including well-maintained facilities, communal spaces, and on-site services such as 24-hour security and concierge services. Professional management ensures consistent quality and maintenance. With the right policy and planning framework, the BPF predicts that we can double annual buy-to-rent output to 30,000 homes across the UK, boosting choice and quality for Londoners. Investing in purpose-built student accommodation, PBSA, is also essential in a city with so many globally renowned higher education institutions. High-quality accommodation is an increasingly important part of the offer to students and postgraduates. It enhances the overall student experience, offering safe, comfortable and conducive environments for studying and living. PBSA can help alleviate the pressure on the wider rental market, freeing up homes for others to live in. One of the most significant developments in recent years has been the growth of private sector capital invested in our pensions and savings, seeking to invest in social housing. This boosts supply either directly through development activity or indirectly through the acquisition of existing assets. Partnerships between the not-for-profit and the for-profit sectors are emerging, with a shared ambition to deliver quality, sustainable investment in this sector. With the right framework, billions of pounds more of new money could be unlocked for social housing. The BPF's manifesto sets out the property industry's offer to the next government to unlock investment into our built environment, to build the homes, critical logistics infrastructure, workspaces and leisure destinations that London and the country needs. The BPF's members want to play their part in the city's fourth great housing boom. Further, they are offering the new government an opportunity to work with them to unlock new investment, power London's economy, build new homes, and maintain London's preeminent status on the world stage. For buyers and investors, both domestic and international, non-traditional areas of prime central London contain a wealth of opportunities. London is renowned globally as a destination for property investors. A third of high-net-worth individuals from the Gulf Cooperation Council region invested in London property last year, according to Al Rayyan Bank, more than any other major global market. Typically, high-net-worth individuals gravitate towards the heartland of the prime central London market when seeking a property investment, encompassing boroughs such as the City of London, Kensington and Chelsea, and the City of Westminster. This is hardly a surprise. These areas are known for their luxurious buildings, historical significance, green spaces, great schools, and cultural vibrancy. But our understanding of the prime property market is shifting, and brokers working with high-net-worth individuals will need to take note of buyers' evolving preferences. There are areas of central London outside what we typically consider to be prime central London that are increasingly experiencing high demand from investors and wealthy buyers, including Camden, Notting Hill, Shoreditch and South Bank. It's worth considering what is driving demand in these neighbourhoods and what the implications may be for lenders and brokers. Notable urban regeneration projects have taken place in these London enclaves over recent years. This has boosted their desirability and increased the number of properties available, while each has maintained its unique character and charm. Consequently, we've seen a generational shift as young, affluent buyers opt for these less traditionally desirable areas of the city. Those who've spent time in these parts of London will appreciate why. The cultural, culinary and entertainment options are growing significantly. Brokers representing high-net-worth buyers must take note, understanding that their clients may well explore less traditional hotspots around the capital. Meanwhile, with a mix of historical, post-industrial and contemporary architecture, there's a wide variety of property in which a new generation can invest. Finally, from an investment point of view, these areas are still located in central London, which means they enjoy many of the same benefits that the traditional postcodes of the prime market do. Indeed, owing to their location, prestige, quality and demand among domestic and international buyers, they have similar potential for capital growth and resilience. For home buyers and investors, both domestic and international, these non-traditional prime central London areas contain a wealth of opportunities, with data showing that they have outperformed the rest of the UK in recent years. Notting Hill is one of London's most desirable areas. With colourful houses, a famous market and celebrity residents, its property values have experienced a huge increase of 101% in the past 10 years, according to data from Kinley, Folkert and Hayward, rising by 11% in 2023 alone. This at a time when average UK prices have been in decline. Shoreditch has enjoyed arguably the most significant transformation in the past decade. 1 in 10 properties exchanges for over £1 million, while overall average prices have risen from £1.07 million in 2013 to £1.38 million in 2023. Similar trends can be seen in the rental market in Camden and Kentish Town. JLL reports that between 2011 and 2021, rental prices for flats rose by 19%, with house rental prices rising by 9%. The firm also forecasts a 25% sales price growth and a 17.6% rental growth between 2022 and 2026, so the prospect of higher rental returns could provide more opportunities for investors. Clearly, these less traditional areas are gaining popularity and value, thanks to their location, amenities and character. They offer a different lifestyle from that of the traditional PCL areas, appealing to a typically younger demographic while still carrying the potential to deliver strong investment returns. Are these areas challenging prime central London postcodes? Or do we need to define prime central London? I don't think so. The distinct singular features of luxury properties in prime central London postcodes restrict direct comparisons. The likes of houses in Kensington and Chelsea have been sought after for centuries, long representing the top echelon of the property market, not just in the UK but globally. This enduring appeal of the PCL heartland is not being challenged by up-and-coming boroughs such as Notting Hill or Shoreditch, but brokers representing high-net-worth buyers must take note. Nonetheless, understanding that their clients may well explore less traditional hotspots around the capital. Labour's plans for the rental market are loosely modelled on policies adopted in New Zealand in 2021. Labour plans to allow renters to bid voluntarily above the asking price on properties. A move, experts warn, could undermine efforts to prevent bidding wars that drive up rental prices. Sir Keir Starmer vowed to introduce a law to prevent landlords from getting prospective tenants to bid against each other for rental homes. We've got to stop the bidding wars, because what happens is that the landlord effectively goes to 2 or 3 different sets of renters, driving the rent up and up and up. We won't allow them to do that, he said during a visit to a housing site in York. Wes Streeting, Shadow Health Secretary, said Labour would compel landlords to clearly advertise rental prices, ensuring that the advertised price matches the final charged amount. However, a senior Labour official stated that if a renter chose to bid above the advertised price to secure a property, then that's a voluntary thing and would be allowed. The official clarified, the idea is that the agency can't facilitate the bidding war to drive up the price on behalf of the landlord. Labour's plans are inspired by policies in New Zealand, which ban landlords from encouraging tenants to bid above the asking price, but allow renters to offer higher prices voluntarily if not pressured or advised to do so. Critics argue this creates a loophole. In New Zealand, average rental prices have risen faster since the policy was implemented. Lucian Cook, head of residential research at Savills, noted, such as the shortfall of stock in the UK private sector, you're always going to have a competitive bidding environment. Whether or not it is encouraged or invited strikes me as being sort of not the point. Labour did not respond to a request for comment. The party has made affordable renting one of its election promises, vowing to overhaul regulation on the private rental sector in its manifesto. Labour holds a commanding 20-point lead ahead of the Conservatives, which could enable it to form a government in the upcoming election. The UK's red-hot rental market, coupled with a dwindling supply of properties and rising mortgage costs, has led to soaring prices across the UK. There are roughly 5.5 million private rental homes in the UK, with more than a third of these households spending half their take-home pay on rent. Evictions due to rent arrears reached record highs in early 2023, according to Generation Rent. Activists have long called for rent controls to limit rental price increases, though Labour has been resistant. Labour also proposes to limit the amount of rent tenants can be asked to pay up front to secure a property. Scotland's devolved government has imposed legislation limiting annual rent rises and implemented a moratorium on evictions to protect tenants. NatWest has reduced the cost of fixed-rate mortgage deals by up to 0.17 percentage points, ahead of the Bank of England bank rate announcement, writes Joe Thornhill. Other lenders may follow NatWest in lowering their mortgage rates in the coming weeks, despite the Bank of England holding the influential bank rate at 5.25% today. The expectation is that the rate will be cut by the Bank of England at its next meeting on 1st of August, likely by 0.25 percentage points, bringing it to 5%. NatWest has agreed to acquire the retail banking arm of Sainsbury's Bank. Sainsbury's will pay NatWest £125 million for taking it off its hands. NatWest will gain around 1 million Sainsbury's Bank customer accounts as part of the deal, which is expected to be finalised next year. NatWest has cut selected rates for residential purchase and remortgage, available direct and through brokers, including first-time buyer, shared equity and help-to-buy deals. The bank's 5-year fixed rates for remortgage now start from 4.26%. This is for an online mortgage deal, which must be applied for and managed solely online. It has a £1,495 fee, and borrowers must have at least 40% equity in their property, 60% loan-to-value. Its equivalent 2-year online-only deal starts from 4.82%. Standard 5-year fixed rates for home purchase start from 4.4% with a £995 fee, 60% loan-to-value, or from 4.83% over 2 years. Online and green mortgage deals for homes with energy performance certificate rating A to C start from 4.35% for 5 years or 4.78% for 2 years. Virgin Money is making some changes to select fixed-rate mortgage deals available through brokers, effective from 8 p.m. on the 20th of June. It is slightly increasing the rate on its 5-year fee-free purchase deal for borrowers with a 25% cash deposit, 75% loan-to-value, from 4.66% to 4.67%. In contrast, the bank's 5-year fee-free fixed rates for a purchase at higher loan-to-value are being cut. For buyers with a 10% cash deposit, 90% LTV, the rate is cut from 5.09% to 5%, and for borrowers with a 5% deposit, 95% LTV, the same deal will see its rate shaved down from 5.4% to 5.35%. Virgin's buy-to-let mortgage deals are getting a more significant rate cut of up to 0.31 percentage points on selected rates. Standard buy-to-let 5-year rates with a £995 fee will start from 4.78%. Suffolk Building Society has cut a number of its buy-to-let mortgage deals by up to 0.3 percentage points, including rates for expat buy-to-let and holiday homes for UK nationals living overseas but wanting a property in the UK. Among the mutual lenders' reduced price deals is a 2-year standard buy-to-let deal at 80% loan-to-value at 5.69%. There is a £199 application fee and a £999 product fee on the deal. The number of millionaires leaving Britain is expected to double this year amid Labour's tax raid on non-doms and private schools. A record 9,500 people with assets excluding property of $1 million or more are forecast to leave the country in 2024, according to expat wealth manager Henley & Partners. Last year, 4,200 millionaires left. This comes as Labour revealed plans to strengthen the Conservatives' non-dom reforms in its manifesto last week. Both parties have committed to making the non-dom regimes less generous, but Labour went further, pledging to raise £450 million by closing a loophole that allows non-doms to avoid paying inheritance tax on assets held in trust. Advisors to non-doms have warned that many wealthy foreigners will exit the country if they're forced to pay the 40% inheritance tax charge. Britain's inheritance tax rate is one of the highest in the OECD group of leading economies. Henley & Partners' annual private wealth migration report, based on data on more than 150,000 high-net-worth individuals, found that the number of millionaires in the UK has dropped by 8% over the past decade. In contrast, other countries have seen increases. France's millionaire population grew by 14%, and Australia's soared by 35%. This year's report predicts the UK will lose the second most millionaires of any country, overtaken only by China, which is expected to lose 15,200 wealthy residents. Hannah White of the Institute for Government said economic and political turmoil in the UK had already triggered an outflow of millionaires, which is now being accelerated by hostile policy decisions ahead of the election. For those educating their children in the UK's well-regarded private school sector, Labour's commitment to remove their exemption from 20% VAT is a further unwelcome development, she added. Around the world, 128,000 millionaires are expected to relocate in 2024, more than in any previous year, Henley & Partners said. The firm noted that China would suffer the biggest outflows, which would be more damaging than usual to its economy due to the recent slowdown. Meanwhile, countries with low taxes and golden visas are expected to gain thousands of millionaires this year. The United Arab Emirates tops the list, attracting 6,700 from countries such as India, the Middle East, Russia and the UK. The US is predicted to draw in 3,800 high-net-worth individuals, and Singapore anticipates inflows of 3,500. Dominic Volek of Henley & Partners said, "As the world grapples with a perfect storm of geopolitical tensions, economic uncertainty and social upheaval, millionaires are voting with their feet in record numbers." A report published last year by Swiss bank UBS indicated that Britain fell to 6th place in the global ranking of millionaires, with 2.5 million people holding assets of £1 million or more, compared to 2.8 million in France, 6.2 million in China, and 22.7 million in the US.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.